Joining us now is Evercore Chairman Emeritus and BlackRock Co-Founder Ralph Schlosstein, right here on set. It's great to have you. Welcome.
It's great to be here.
Let's start right there, because what an incredible second quarter we had. Tariff tantrum. Is it over? Is the fear about peak tariffs behind us?
Well, I think you can never say it's completely behind us, because I don't think we have a absolutely certain path as to where the president and his team are going to take the tariff discussions and how our trading counterparties will react. But I do think there is a strong desire on the part of both our government and the governments with whom they are negotiating to have as least a disruptive settlement of these discussions as we can have. So I'm cautiously optimistic that there won't be any big disruptions as a result of tariffs over the second half of the year, but I'm sure there'll be some mini tantrums.
Yeah, volatility certainly seems to be here, at least here to stay in this market right now. Goldman Sachs this morning pulled forward their outlook for a Fed cut sooner to September, and they basically said, look, inflation is not materializing the way we thought it was going to through the summer. Do you see it the same way, or is it still too early to tell?
You can never predict with certainty future economic statistics, but the trend for inflation certainly seems to be positive, and they're laying a very strong foundation for a justification for a cut in September. And at the same time, we're seeing a teeny bit more looseness in the labor markets, which would also gently push you in that direction. So I think if you look forward, it's pretty clear that the next directional change in interest rates from the Fed will be downward. I think the only question is how many cuts do we get this year? I would be in the camp of 2. And if it's not 2, I'd say 3 rather than 1.
3 rather than 1. Why? Because maybe the economy's not holding up as well as hoped?
I just think there's enough room, both in the inflation statistics and in the employment statistics, to gradually take the Fed funds rate back toward neutral.
Where do you think we end the year with markets? And I ask this knowing that we're starting to see some signs of the IPO market percolating and M&A. We got some deals today. There seems to be some more liquidity coming into this market here. Does that continue?
Well, let me first talk about M&A, and then I'll talk about the markets generally. I said at the beginning of this year that I was very confident that 25 would be a stronger year in M&A than 24, and that 26 would be a stronger year than 25. Obviously, the first few months of this year had a huge amount of volatility and uncertainty, so the pickup in pace that I had anticipated has been a little slower than I expected. I still stand by that. I think 25 will be better than 24 in terms of dollar volume of activity, and 26 will clearly be better than 25. With respect to the markets as a whole, I think if you look at the big picture, first, monetary policy, as we discussed, is going to, in my view, become somewhat more accommodative as the remainder of the year goes by. We clearly are going to have a very stimulative fiscal policy when the big bill, whether you call it big and beautiful or big and something else, passes, as I think it's almost certain to do, maybe with some, Sturm and Drang over the next few days to get it done. But I think it's inevitable that something passes. And what does pass is highly likely to be very stimulative from a fiscal point of view. So you've got a somewhat more accommodative monetary policy. You've got a stimulative fiscal policy. I think government actions are going to do their best to not be disruptive of the confidence that is building in the economy generally. So if you ask me to bet, that's not my job, but if you ask me to bet, our stock market's going to be higher at the end of the year than they are on June 30th, I would bet that, and I would, probably make that 2 to 1 or more.